Hello and welcome, and thanks for joining us today on this Friday afternoon. Another market update webinar. We appreciate you joining us, and it's raining here, so hopefully wherever you're at, you've got a little bit better weather. As always, I have Beth Foley and Bill Davis and Matt Arenz joining us remotely, and we wanted to give you some updates on what's happened over the last couple weeks, and also give you an outlook here over the next many coming weeks. So I'm going to jump right into it. So the agenda today is, the first thing we want to talk about is review some of the key items we've discussed in the past. You know, we've been doing these now since March, when the global pandemic really came about. And so we're going to just talk about some of those key items that we have talked about, and some of those are still key items moving forward. We're going to talk about what we're looking for in the next 6 weeks or so. And we picked 6 weeks for a reason, and we'll share that with you all today. And then we'll talk about where do we go from here in the market, and what's the next anchor. We'll talk about the anchors that we think the market's had up to this point, and we'll talk about what the next anchor is. So let's jump right in. And we've talked about many topics over the last many months, including unemployment. We've talked about the VIX, which is the volatility index and measuring volatility. We talked about emotional investing, the Fed actions, what the Fed has done, and has had many actions that have been well received up to this point, and we probably would not be where we are right now in the market if it weren't for those Fed actions. Consumer confidence, as well as Wall Street versus Main Street. So I'm going to throw it out to my panelists here and see who wants to kick it off and talk about some of these key points that we want to discuss today.
Well, Eric, I just 2 weeks ago when we had the call, I brought up those three risks: the pandemic risk, the political risk, and the economic risk. And Texas and Florida, as of noon, just shut down their bars. So the pandemic risk hit on June 10th, when we had 29 states that weren't following CDC guidelines. What happened? The market went down 7.5%. And today, with Texas and Florida bars, Texas and Florida experiencing a spike because they've totally opened up the system. Now they're shutting down those institutions. So there's a perfect example of what I was talking about: pandemic risk and spikes, and the market's reaction to that. And what's to follow, I think, is probably going to be economic risk, bad economic reports, and then not forgetting about the political campaigns that seems like just starting, even though we're almost to 4th of July.
Yeah, it's good points, Bill. And I think about the period, and we talked about this over the next 6 weeks, but we're entering into another holiday, and where does that lead going forward?
True. And, Eric, one of the things that we've talked about that I brought up a couple of times is the VIX index, the volatility index, and consumer confidence. When we started this and doing these live, weekly updates and so forth, we had looked at, the month of January and February, the VIX, or the volatility index, was very low at about 16, 14 points around there, and spiked up to about 62 points in mid to late March. And as we've been doing these, now bi-weekly meetings, we've seen the VIX slowly coming down. Remember, a low VIX number is good. There's higher consumer confidence there, and lower volatility expectations. And, the VIX came down to about 22 points. And over the past week or so, it's come back up. It's been increasing today as we see the markets going down today. To Bill's point, as we're seeing economies closing down again in Texas and Florida. So the VIX is back up above 35. So still significantly lower than it was in late March, but higher than it was. We felt like we were cruising along and it was just coming down and down and everything was going to be good. But we knew that that couldn't be true, and the volatility index, consumer confidence, is beginning to fall a little bit again as a result of higher infection rates and so forth over the past week.
Yeah, and I would even say, consumer confidence, quite honestly, has actually done better than I think most people have expected. Slowly rising, but to Beth's point, dropping a little bit here recently. I think the other thing I think of is, the unemployment numbers that we've been tracking. A lot of the press has been around, new claims for unemployment benefits, which continues to grow week over week. And one of the things I think we were a bit surprised on last time was the actual unemployment number. So unemployment claims versus the actual unemployed. And that number kind of surprised people. I think even the last couple of weeks, that number growing again of fresh people on unemployment. But it'll be interesting to see what happens. I think it's next week or the following week of what that actual real data unemployed is, because as things were opening up, although people are going unclaimed, there's definitely a lot of service industry that has been coming off. So that those numbers can be a bit confusing, but as to Bill's point, as things shut down again, or if they shut down, it's just going to be a whirlwind of that real number. But it's just a big number to begin with. So I think that's just going to take some time to actually calm down, to see where things kind of just level out for a bit.
Yeah, there's some good points. So, a lot of people get excited about their seasons, whether it's fishing season, hunting season, golfing season, whatever, different seasons. While us advisors get excited about earnings season. And so earnings season comes every quarter, and we're going to have another earnings quarter here. Believe it or not, we're almost at the end of the second quarter. And so we know that the second quarter earnings are not going to be good. So Matt, maybe you can start off the discussion on what do we think that's going to do to the market?
I think some of it'll be priced in. I think it's the complexity is, as CIOs were coming out and just saying, well, it's not going to be good. They weren't really giving analysts much to work with on expectations for what earnings season would look like for the second quarter. So even analysts are just, there's a pretty wide range of share price targets for second quarter earnings. And I think that is going to be a tough thing. I also think that, you're seeing even just, the smart money, dumb money on here would suggest things like we're seeing massive amounts of money being thrown into really, really risky asset classes, which is kind of counterintuitive to where people would be at in these, cruise lines, airlines, travel industry. But you're also seeing massive amounts of money and a lot of stimulus money, which is the government coming out saying, hey, people are throwing stimulus money into these stocks and a lot of bankruptcy stocks. So people have right now kind of this unusual appetite for risk because they're looking to turn a quick buck, which has created this weird volatility in the market. We're seeing areas making money that otherwise wouldn't. So, earnings season is going to be interesting, but it's obviously not going to be good. The question is how much of it's priced in. I think there's going to be a good chunk, but depending on how bad actual earnings are, which we really have no measuring stick on what that's going to look like. I think some sectors will hold up well. I think some sectors are going to be hurt pretty bad.
Hey, Matt, I have a question for you. We talk about Wall Street versus Main Street in this disconnect over the past months as the markets have been flying high. And, on Main Street, people are unemployed, businesses are shutting down, we're seeing bankruptcies and so forth. And in my mind's eye, I always picture Wall Street versus Main Street as Wall Street, big institutional investors and all of that, versus Main Street, people like you and me. But when we talk about the smart money, dumb money, and the small investors chasing this, it's like the Main Street people are disconnected themselves from what's happening on Main Street. And it's just this picture that I have in my brain from what exactly you just said, that wait, it may not just be the institutional folks, but everyday people through small investors also causing to this, this disconnect between Main Street and Wall Street. And it's a very small point. It's just, you just changed my perception a little bit in what you just said, as far as, individuals chasing momentum stocks at this point in time. So.
Yeah, and Robinhood is kind of the big phrase these days, which is just basically a small brokerage platform that allows you to trade on your phone. And you're seeing a lot of people use that because they're just buying these nickel and dime stocks, which is great. It's good to see people going on the, with their investment platform. But you're also seeing a lot of people who are on unemployment benefits. I think the number is like 50 or 60% of people are actually making more money on unemployment than they are when they were employed. And so that savings rate, which bumped from 8 to 9% for a household, is now upwards of 30%. So those extra dollars they're now throwing into these small trading platforms, saying, hey, how can I buy up a lot of these penny stocks or bankruptcy stocks for opportunity? So I think people have just this appetite for risk, and they're trying to do something with it, which is good. We just hope that it doesn't turn bad on them.
So Matt, fresh numbers as of this morning is that the savings rate was at 32% in April, came down to 23% in May, which I think is to be expected, as retail was opening up, restaurants were opening up around the country, and things like that. So that's pent up money that's coming back into the system. So savings rate coming down. And I've actually heard this now from a couple of clients this week, and we're going to talk about what we expect in the next 6 weeks. But one of the key things to look for is that the extra unemployment benefits end at the end of July. So that extra money that's making it, in a lot of cases, people making more money while not working, well, that comes to an end unless something happens in Congress. And so that, we'll talk about that a little bit more in a minute, as far as what to look for over the coming weeks.
Yeah, some really good points. So let's lead into that then. Where we are and kind of what we think about. And we said the next 6 weeks we're kind of leading into, that first week or so in August. So Bill, what do we, we've had some discussions around it kind of in the folks that we follow and kind of track. And, we tell you out there, clients and guests all the time that, we could jump on the webinars, which is great that we have resources, webinars and calls pretty much all day long, Monday through Friday. So what are some of the things that we're looking for over the next several weeks?
Well, as we referenced, L. Arian at PIMCO, he talked about some of these anchors, and the anchors that sent the market higher over the previous 3 months, basically. So the fiscal policy comes into play. All the monetary and fiscal policy comes into play, and people look at that as a positive, and then the market moved to another level, and then we kind of staggered there a little bit. The reopenings began. That was another anchor. And then people began to throw money at the things that Matt just referenced. So the retail flows started to come in, and they're not supporting the market anymore. They've kind of peaked out. Now we're starting to get some bad news on the reopenings. So, what he was speaking about this week related to what's going to be that next positive anchor point that the market can launch itself off of. And it's an uncertain that we're looking for. Mm-hmm. We were hoping it would be, the next group of states that reopened. And we may see that, really the phases that the worst places like New York, Connecticut, and that, they are a little slower in reopening. And in fact, put in the travel restrictions, the 14-day quarantine for people coming from places like Florida and Texas. Because they were like, we don't want this thing to spike in our state again. Yeah. So that actually was a negative in the markets this week. So the markets, responded to that negatively. They didn't see it as an anchor point to launch to the next level. So that's kind of what we're searching for in the next 6 weeks, is some positive news, maybe coming out of biotech as it relates to some of these treatments and stuff, that will be the next anchor, that will be the next launching point to go to the next high in the market.
And we've been told, right, by the Fed Matt, that, the Fed said, look, we're going to do what it takes. We've got a lot more tools in our toolbox. And you mentioned earlier about the unemployment numbers, and, some people are making more. Those are running out. Those additional benefits will be running out. So probably some more actions by Congress as well.
Yeah, I think so. I think they're, maybe just letting things simmer for a bit to shake out. Hopefully it doesn't become a political tool. Inevitably, it seems like it does. But, we talked about the Republicans having and Trump having a $2 trillion infrastructure deal that he's trying to gain some traction around. The Democrats have about a $3 trillion additional stimulus package that they're kind of talking about. And, right now there's not really a happy medium. Nobody's looking to make a bipartisan deal. So, I think when Congress kind of gets back in session, we'll see some other things, but I think some of that will depend on how fast things move in the market. If we start seeing the market drop pretty quick, they're probably going to get on the horse a little bit. But until then, I think it's just going to be a little give and take, and again, hopefully not becoming just a straight political re-election campaign tool.
So it comes back around to this, what we've talked about, several times on our call here, is the unknown of kind of, second wave, and also obviously eventually a vaccination. And I know one of the things that will be talked about, because it is a, big part of, everybody knows, is Disney reopening, and they're on target now to open up here in a couple weeks. But it appears that that's going to be a real challenge. And then, other opening schools and so forth. And it's in the unknown, right?
Yeah, and Eric, I think another kind of signal that is more of an emotional one that could really drag into consumer sentiment and so forth, not just Disney, but Major League Baseball and the NBA coming back on board too. They have these plans to launch them and to get the teams playing again, the NBA down at Disney. And if they are not able to do that because they can't control infections within it, I think that's going to be a big emotional drag, because it's so visible of whether or not that happens or not. If they can play and, control things and keep people healthy, well, that's going to, be an emotional lift. But if they start down that path and then it reverses itself, just like we're seeing, Texas and Florida reversing today as far as their openings, that could be a drag or something that happens over the next 6 weeks. We talk about anchors, and anchor can be two things. It can, as I just said, it can be a drag on something and hold you back, but it also can be a stabilizer as well. So we're looking for that next stabilizer in the economy to help us take that next step forward.
Yeah, and another one, when you look at it, even earlier this week, was just the U.S. relations with China. Misinterpreting of words in the evening, all of a sudden the future markets were negative, 800 points in the Dow, and then somebody corrected a statement and all of a sudden it was positive. And so, that's holding on by a thread, and that could end up being a short-term anchor that says, hey, we're working on a good Chinese deal for trade relations. But right now, that's a struggle as well. And so we would hope that in times like this, you would just, come up with a good compromise on all sides, so that we could just push forward, because that again will affect things like supply chain and just all the above trade.
Okay, good. So let's take a look at kind of how we're thinking about it in key takeaways. Our first one, we talked a little bit about it, but other comments on how we think about the markets will react in second quarter results. Matt kind of touched on that, probably a little bit priced in, but any other comments on that?
Yeah, I think the markets have priced in most of what are going to be zero earnings for a lot of companies and a lot of losses. You're looking at burn rates of, I heard a number this week for American Airlines, $40 million a week, and they borrowed another $3 billion just to last them 24 months because they know how bad it's going to be. So I just think that everybody understands that the second quarter results are going to be the worst results. And I don't think people are trading based on results, which is the whole disconnect. You know, it'll be a long time before we get back to people looking at true valuations of stocks. And I think all of the reports coming in the second quarter here in a couple of weeks or so are going to be no guidance going forward. So they're still not going to be able to tell us when they're ever going to make a profit again, or what their profits are going to look like in the future. So analysts will have a very difficult time valuing companies. And we're fortunate that companies have been so good with their cash flow over the last 10 years. And so their balance sheets, most good companies, their balance sheets are in a better position coming into this, that they're able to sustain it. But I'm not sure that the second quarter results are going to have much of an impact.
And what about, you know, in the news this week has been banks and lifting some of the restrictions for more lending and so forth. How do we think that might come into play?
That's a big deal, because the objective is to, and I don't know if I'm interpreting it correctly, 'cause I'm hearing a couple of different sides of the story, but yeah, lifting regulations to allow banks to access more of the capital markets, a little more aggressive stance to access more of the capital markets, to help them with their cash flow, and these stress tests that they have to go through, and making sure that there's money for liquidity. But at the same time, there's also discussion of banks being restricted as far as their ability to buy their own stock. Will they be restricted as far as being able to pay dividends? Those sorts of things, to also keep them cash rich to handle liquidity. And I shouldn't even bring this up because I don't know the quote through and through, but there was something about Chairman Powell's discussion last week about whether or not the banks could face a double stress, that they do these stress tests with banks to make sure that they have sufficient funds, and that what we could see coming in the next few weeks could double the amount of stress that they would normally see as they're doing these regular tests. So more to see with banks and regulations and lifting of regulations, but also imposing others to help them keep enough cash on hand so that liquidity does not become an issue for them.
Yeah, and they even put restrictions on the banks that basically said, hey, we're going to have restrictions on your dividends, and we're going to have restrictions on buybacks and stocks, so banks keep an excess amount of cash for liquidity. So I mean, the stress test basically just saying, hey, we just want you to be a little cautious. I think that's probably going to help. But it also hurts bank stocks at the same time.
Mm-hmm.
Yeah, and we've mentioned this many times, but the Fed, and at least their actions up to this point, have been congratulated from those in the investment world, and said that they really have made the moves they have made have been good moves to kind of help put some plugs in the hole, so to speak. So our next takeaway is mid-July could be telling. Why is that, Bill? We talked a little bit about it, but why mid-July?
Well, we have a 4th of July weekend coming up next weekend, and what has been demonstrated in Florida and Texas and Arizona, where people were not social distancing and the states didn't follow the CDC guidelines on the data points. I think they have pretty specific data points that they want to see before you open up things like bars and restaurants. So we're going to have people congregating over the 4th of July weekend. 14-day after that puts us mid-July, and that's why we're saying mid-July could be telling as it relates to the pandemic.
Also, we think on people that have rebooked trips and travel and moved it from March to maybe towards the end of summer. Do those get shifted again? And then plus what we talked about with all the economic data coming out with second quarter results, and then Congress being back in session, and all of that coming together, and then and we have an election.
Right, because as we start pushing toward the end of July, We've got the Republican convention mid-July, right, late July, and then the Democratic convention mid-August. So as we push toward, politics, it's kind of out there and it's happening. But as we push closer to those conventions and the nominating conventions, I think politics and the dialogue and publicity about what's being said on those party platforms with regard to the pandemic and regard to the economy, that's going to start, I think, filling more of the media space as we push toward mid and late July as well.
Great. Our third takeaway is, well, first, we often get as advisors kind of, how are you doing? How's your family and how's the team doing? And I want to let everybody know that, our team is doing well. And, since really almost day one, we were able to take almost everybody and work mobile and continue to be able to provide service to our clients, service and advice. So, we're fortunate enough in the business that we can take it and utilize technology. So that has been working well. As a firm, we are continuing client appointments, either phone or virtual, and are doing some, will be coming up, some client with CDC guidelines, some client appointments, but still encouraging it to be phone or virtual. We feel as though we don't need to jump into it too quickly, but we also want to be accommodating. So that's our thoughts kind of going forward. And as we said, mid-July will be telling. And then communicating really what's happening in the market. So when this originally happened, we really wanted to get information out. And of course, it was changing literally by the hour, if not by the day. And so we wanted to make sure we get information out. And we've had hundreds and hundreds and hundreds of you over the course of the last many months. And so we went from every week, and then we went bi-weekly. And what we're going to do going forward is we will continue to communicate in our monthly communication that we send out. Then if we need to have a webinar, something's happening within the markets that we think we should discuss and let you know kind of our direction and thoughts on it. It's not necessarily based on just market volatility, but other things that happen. We'll have a webinar, and you'll get notice of that, of course, and you can sign up for it. We felt as though with the summer and the bi-weekly webinars that we've been having every other Friday, we're not going to continue those right now, and we're going to go more as things come up. Unfortunately, there probably will be times where we'll want to communicate a message, and we'll get that out quickly, so you can look for that as well. And then, of course, with your interaction with each of us, as you're working through each of the advisors, we're here to talk about and kind of go from there. To wrap it up, I also want to thank everyone that has participated in the Give Back campaign for the COVID-19. It is a program that is kind of over, but if you talk to somebody, maybe we can still do it. We're providing a match. And you can go to our website and get that information off of the website. We had a lot of good participation in people helping really COVID-19 relief funds. So we do appreciate that. And the last thing I want to mention is if you have not watched the Your Wealth Health show, you can watch it online every Saturday morning at 9:30. Watch it on Facebook Live, or if you're in the Michiana area, you can watch it on Fox Michiana at 9:30 every Saturday. We've had several topics, including reverse mortgages. We've had Ed Slott as a guest. He's a IRA retirement expert, where we are actually members of his elite advisor program, as well as some other guests and topics. And so we cover various amounts of financial topics, and we've gotten some really good feedback that's brought some good information to all of you. So if you haven't caught, you can catch those episodes on our site. So with that, I want to thank Matt, Beth, Bill for participating over the last many months. We will be bringing future webinars, just don't know when. We want to bring them as needed and on time, on a timely fashion. And so I will thank all of them. Thank you very much, everyone, for participating.
Yep.
And I thank all of you for being a client or being friends of the business. And we wish all of you a happy and safe 4th of July. And we'll see you soon. Thanks so much.